Good morning. My name is Ruggiero Lomonaco. I'm the head of real estate funds for Rasmala Investment Bank. Today we are going to talk about an interesting topic, which is mainstream open-ended real estate funds having raised the gates, limiting redemptions. This is a topic that has been widely reported in financial press. Today is 12th of December 2022. It's 9 o'clock in Dubai. So, first of all, you might have read in the press that funds like the Blackstone Real Estate Income Trust, the KKR, non-traded REIT, and other, Starwood, they have limited the amount that investors are allowed to redeem or the buyback of shares. So, what is going on? First of all, let's start from an analysis of the listed real estate markets. You know, the equity markets are forward-looking discounted machines, so they adapt very fast to changing market conditions. Inflation increased, interest rate increased, the equity market, the real estate, the listed real estate market fell at some point by 33.38% in the middle of October. It has recovered about 12.47% from that, but clearly it's in a bear market. So very, very big drawdown. Private markets, completely different story. The NCREIF property index, sometimes referred to as NPI, is up at September 9.35%. So as you might have heard, this beginning of October, all the managers were advertising their performance and then saying that proving, I mean, at least that the performance that proves that private markets are uncorrelated to listed markets in a way, in a year where the REITs lose at some point 33%. The private markets were up 9.35%. The reality is slightly different. If we look at the Green Street Commercial Property Price Index for the US, we can see that this index indeed of private market transaction has indeed fallen by 13% this year. What's the difference? Why this index is signaling a return? It is because it is based on discounted cash flows. So it takes the information of a large number of properties that they have in their database and discounts these properties by a discount rate that reflects the current interest rates. Current interest rates have gone up, the value of the properties have gone down. So this will be the valuation approach of someone who wants to buy a property. Okay, he looks at the expected return based on the prevalent market inputs. Okay, so what happens? Whilst the NPI index is reflecting the value of the transaction that have been actually executed. So what happens? We have a seller that has a property worth 100 and a buyer that wants to buy at 85. If the seller doesn't need to sell, that transaction doesn't happen, and it is not recorded in the NCREIF index. Okay, so only where the buyers was willing to pay the price requested by the vendors, the transaction have taken place. And this has been a market where the vendors were not forced to sell. They have locked for a long period of times the funding. There is still not redemption request, so they needed to sell. The redemption request came, the managers put the gates, so again there is no pressure to sell. Another thing that has been happening is that the managers have the ability to price not only the assets but also the liabilities. So when you need to produce an NAV as a real estate fund manager, you can ask the external valuer to give you a valuation of the asset, but at the same time, you can ask an independent party to give you the valuations of your liabilities. Why? Because liability, it's a set of cash flows, typically at a fixed rate. The value is the present value of the liability is it's calculated using the current interest rates. So if the interest rate has increased, the value of the debt has decreased. The same situation if you have a floating rate loan and a fixed to floating interest rate swap. The liability will be kept at the notional price, but the value of the swap increases. So it is actually a gain in your P&L. And I've read this on a number of reports of other managers. So everybody pretty much has adopted this methodology, which has protected the NAV. So, give you an example. This is our fund. This is the Rasmala North America Real Estate Income Fund. This is a fund that we've been managing since 2020. Year to date, very good performance at 17%, which is in line with what we did in 2020, where we did 20%, 2021, where we almost did 25%. Okay, but as you can see, there is a pattern of cash distributions slowly. Because what we do in our fund, we pay both the income and the realized capital gains. Okay, so in 2020 to 2021, where we had a large position of REITs, we could actually sell those REITs and pay a distribution which we were trying to be in line with the total return. In 2021, the total return was just too high to pay that distribution. So, but if you have been following my video blogs and emails, about middle of last year, we decided to sell all the REITs because we thought that the market was overvalued, which was a good call. We didn't take any loss there. The problem is that today we only are liquid, so we couldn't sell any asset to pay an extra distribution in line with the 17% on paper return. Reality, so what we have been paying is just the income that we receive on the underlying properties. So cash is king. Okay, so it's very important to monitor what is the distribution of the investor. So I'm not saying that we have done a bad job. I mean, I think we have done a great job in this fund. I'm just telling you the reality is that I'm just telling you the reality. Okay, so now let's move to the next fund. This is the Blackstone Real Estate Income Trust. This is $125 billion fund with an NAV of approximately $70 billion. So as you can see, also this fund, very good and stable performance this year. Performed slightly less than our fund. And it started receiving redemption request because the market can see that there is a drawdown coming in the valuations, and they put the gates. I mean, this fund has a limit of 2% per month of the NAV to redemptions and 5% in a quarter. They exceeded that return, that level of redemption request, so they limited the redemption request. Here you can see the KKR Real Estate Select Trust, also known as CREST. This fund also did very good in 2020. I mean, this just was launched in 2020. In 2021, excellent performance, and 2022 also. I mean, all the way to October, 10.72% is respected. Now, this fund, it's actually closed-ended, but it has a mechanism to tender, to do tender offers on a regular basis. And the tender offers are the mechanism for investors to redeem their shares. So you will see that the amount that they will be able to sell will be decreasing. The thing is that this fund invests a lot of the assets in debt and listed debt, commercial mortgage-backed securities. So these are more liquid. Here you have the Lion Industrial Trust. This is a fund managed by basically Franklin Templeton. Franklin Templeton has bought this company. So you can see excellent return, 23.61%. But they received, I think, 1.4 billion dollars of redemption request. So what did they do? How did they handle that? First, they called the investors that were in a queue. So they called their cash and they gave it to the redeeming investors, and the rest they formed a redemption queue. Here is now another fund still managed by Clarion Lion Properties Fund. This is diversified. They invest also in offices, in multi-families. Year to date, 15% return, similar situation with the redemptions. The redemptions are coming up. So the one that they could do, they could meet, they have met. The one they couldn't meet, they have just queued them, which means that they will have to sell properties, and as they sell properties, you will see that the NAV will come down. But I would expect this to happen during the course of 2023. Here is another fund still managed by Clarion. It's called the Gables Multifamily Trust. Again, very good performance year to date, 19.02%. But as I was reading their report, I can see that they are marking their multifamily portfolio, I believe it was 3.75%. So way too low. Okay, so I would expect also this fund to have some negative total return next year. So sorry. I was talking to Franklin Templeton and about what they're planning to do, what is their expectation, and they shared with me this very interesting analysis comparing the performance of REITs and the non-traded market in past drawdowns. Essentially, they looked at the 90 to 92 period, and they said, oh, look, the S&P 500 on that year, in that period, had a drawdown of 19.92%. The listed real estate index was much more volatile. It lost 34.5%. The NPI index, which is the NCREIF property index, when adjusting by income, lost only 10.9%. So it was a much milder drawdown. In the period between 2000 and 2002, this is when there was the internet bubble bursting, the S&P 500 lost 49.10%, the equity index 36.6%, and the NPI it was positive, must have just like a tick positive, but on excluding the income, it was just down 1.10%. If you remember, this is when real estate market really offered the market, where the market really started looking at real estate as an alternative to fixed income, because interest rates dropped substantially. 2008, 2009, this was the end of the real estate bubble, the housing bubble. So here you have 56.8% total drawdown on the S&P 500, 75.8% on the REITs. The market, the private markets did go down. Total return was a negative 23.9%, but certainly less so than the listed markets. And they were able to measure 2020 to 2020. This was the depth of the COVID pandemic. The markets had a 33.9%, sorry, the S&P 500 33.9% return, negative return. The NCREIF 42, sorry, the Nareit index, the listed real estate index, 42.8%, 10%. Really, during that period, it was too short, really, for the private markets to really post any drawdown. So this like -1% is really nothing. So here, then they says in 2022, the market is down. The S&P 500 was down 25.4%. The NCREIF index, this 33.4%. They've taken this number really close to where we were looking at the bottom. This was like middle of October. So far, the market is positive. We don't know really how long this drawdown will last. We already have seen that the NCREIF index has the Nareit index has already recovered 12%. So their expectation is that the market, the private markets will come down, but not as much as the drawdown of the listed real estate index. So in conclusion, if you have invested or if you were contemplating invested in an open-ended real estate fund, this is a great lesson. This time are great lessons when you learn that there is a trade-off between liquidity and volatility. So if you want to have a less volatile experience than investing in the listed real estate markets, you need to accept less liquidity. So probably we will see basically what will be the attitude to invest in open-ended, non-traded real estate funds post this crisis. So we will see what will be the flows from, I would say, 2024 onwards. But my expectation so far is that investor really should look at this asset class as a kind of a perpetual income type of investment, not something that they can really trade in and out on a regular basis. So I hope you have enjoyed this video blog. As usual, if you want to discuss these matters in more details, feel free to reach out to me. Until then, bye bye.